Okay, welcome back to Introduction to the Financial Services Industry. This video, we're going to talk about something called front running, and I'm going to add this to the playlist for regulatory issues. So let's jump right into this. First of all, my same disclaimer, this is just a high-level introduction, and I'm not going to make any sort of financial advice. Okay, so what is front running? So front running is trading stock or any other financial instrument by a broker who has inside knowledge of a future transaction about which that's going to affect the price substantially. So this is a case where a broker is executing transactions with inside knowledge of some future event. A broker may also front run based on inside knowledge that the firm is about to issue a buy or sell recommendation. So if you're a brokerage firm and you're about to issue a report with recommendations to your clients to buy stock XYZ or sell stock XYZ, that would be inside knowledge that could substantially affect the price. So if you're going to issue that report that says buy stock XYZ, and before issuing that report, you go out on your own and you buy the stock, knowing that your buy recommendation is going to make the stock go up, that would be front running. Front running is illegal and it's unethical. Brokers may not front run transactions, and it's unethical in almost every case, and it's illegal. And brokerage firms can and will get fined for this. Front running is also sometimes called tailgating. So if you hear the term tailgating or you hear front running, they mean the same thing. Okay, so here's how front running works. Again, I'm going to go through these examples. They're fairly simple. The most straightforward example is a broker gets an order from a major client to buy 500,000 shares of XYZ company. Now, the broker knows that such a huge order is going to move the market. So the broker, instead of just submitting that order, goes off on their own, using their own personal account, and submits an order on that stock before that, buys it themselves, and then submits the order, knowing that the client order is going to drive the price up. So that would be a very simple example of front running. Again, front running is illegal. And anytime a broker delays the execution of a client's account, opens the question of, is the broker operating inappropriately? So again, front running is similar to insider trading. There are some differences, and we can talk about that later. So another tactic we talked about, where a client gives a broker an order, and the broker sits on the order and buys it, the position itself, from their own account, and then issues the client order. That's one type of front running. Another type of front running is what I said is, let's say you've got your analysts working on making recommendations, and they're going to recommend that you buy or sell a particular stock. If the broker, if the analysts, before they issue the report, go off and do their own transactions, that would be a case of front running, right? I'm going to use Citadel Securities. And by the way, I'm not trying to call out Citadel because, to be honest with you, Citadel is a great firm. But Citadel in 2020 was fined by FINRA because what they were accused of is they were accused that they were getting orders from clients, and that they were taking some of these very large orders, and rather than process them electronically through the system, they were sending them for manual processing. And that at the same time, obviously manual processing slows it down. And then then they were executing orders electronically ahead of those orders from their own account. And that would be, violating the broker's obligation to their clients. And so they were accused of front running. And they actually paid a $700,000 fine and had to go back to all the clients involved and make them whole, which they did. So that's an example where FINRA, the regulatory authority, steps in, identifies the issue, and fines a member firm. Again, the two types of front running I'm talking about here is in anticipating a large future transaction and holding back on a report. So let's go through this one step by step. So front running the client orders. If you watch the diagram here, you've got a client and you've got the broker. And the client gives the broker an order to buy 1 million shares of XYZ stock. Now, the broker receives the order, and the broker knows that a large order like this is going to move the stock and drive the price up. So before executing the client's order, the broker goes off using their own account, or maybe it's the broker's brother-in-law's account, the broker's wife's account, the broker's, some other account the broker has. The broker goes off and issues his own order to buy the stock before processing the client order, before the stock goes up. And then the broker, after issuing their own order, then it does submits the client's order for to buy 1 million shares, which in effect drives up the price. So by doing this, the broker is able to, using their personal account, because they process the order ahead of the client account, they're able to get the stock at a lower price. And after the price goes up, they could sell the stock right away if they wanted. So front running a client's order, the broker is able to buy XYZ stock before the price goes up, and the broker can realize a very low risk gain. So that's the first type of front running. That's where you jump ahead of the client's order. Then the next type of front running we talked about was anticipating news, operating on this inside information about something that's going to happen in the future that's going to drive up the price. So we'll just give you an example here. Let's say you've got a major brokerage firm and it's got a research department. And that research department at that major firm is going to they're preparing a report. And in that report, they're going to issue buy, sell, and hold recommendations for their clients. Let's say they're going to recommend that you buy stock XYZ and you sell some other stock. So while the research department is preparing that report with those recommendations, let's say one of the analysts on the team goes and takes that information. And the analyst knows that this recommendation is going to make a particular stock increase in price as soon as it's distributed. So what that analyst could do is, based on the information, that analyst goes out using their own personal account or using their brother's account or their cousin's account or someone else's account, goes and buys that stock. And then the report is then published to the general public, the stock goes up. And by doing this, the analyst is able to realize a very low risk gain because they were able to buy the stock before the report came out, and the report provides information that makes the stock come up. Now, it doesn't have to be this type of research report. It could be any future information. It could be a future announcement of losses or a future announcement about dividends. It could be a positive information, it could be negative information. But basically what you're doing is, prior to that information being public, you're going in using your own account to exercise a transaction and realize a profit. And you're doing that with information that's not available to the public. So it's not fair to the general population because you have information that's not generally available. So those are two examples of front running. Now, technology has kind of changed the world. I'm going to talk about this a little bit here. So this is where it gets a little grayer. Technology kind of changes the world a little bit and creates a number of situations that kind of look like, feel like, and are sort of like front running. And a lot of it comes out of high frequency traders. These are traders that are executing large volumes of trades and doing it electronically. And they have computers constantly executing trades. Now, the television program in the United States called 60 Minutes has over the last 10 years done a number of stories on the impact these high frequency traders have and these type of front running situations that get created. And you can find their stories online. There's one you'll find on YouTube from October 2010, and it says The Speed of Traders. And what that talks about is how some high frequency traders using very fast supercomputers and by co-locating computers, for instance, in the New York Stock Exchange, the ICE has a data processing center in Mahwah, New Jersey. By co-locating at the exchange, by co-locating and by using super fast supercomputers, high frequency traders can get an advantage that kind of looks like and feels like the technology version of front running. And again, starting in 2010, this whole issue about co-location begins to be a big deal. Now, there's another episode of 60 Minutes that aired in March 2014 that was very interesting, that kind of blew the lid off some of this, where it talked about how the system's a little bit rigged. And what it was talking about was this whole thing where high frequency traders, by running their own fiber optic connections, by putting in their own fiber optic channels to the exchanges, they're able to create an electronic front running situation. So I'll give you the example here. If you see this map, this actually came right out of 60 Minutes. You see the yellow lines are the regular telco connections, fiber connections, and the red lines are private fiber optic channels that are put in place by the high frequency traders. So you see in these cases, the red channels are slightly faster. So maybe they can get a message through a nanosecond or half a nanosecond or 2 nanoseconds. They can get like just a little bit faster. And as a result, they're able to kind of front run the transactions. So let's say you've got an order, you got a firm that's based in New York, in Manhattan, and they submit an order, and it goes to the BATS exchange in Weehawken. Now, everybody now knows it. So everybody knows that this client is trying to buy 500,000 shares of XYZ. Because the high frequency traders have this faster channel to, let's say, ICE in the New York Stock Exchange facility in Mahwah, they can get their orders to the New York Stock Exchange, in this example, maybe a nanosecond ahead of everybody else. And that gives them a decided advantage. Or let's say they've got a faster connection to the NSX exchange, which is in Jersey City, I believe. So the idea here is by putting in a faster channel, you actually can front run the rest of the market. So this is actually unfair. What happened is the team that, there was a team from Royal Bank of Canada who uncovered that this was going on. And what they did was they then created something called the IEX exchange, which was created in September 2016 in response to this. And what that exchange does is that exchange, through the use of their technology, they have this, they call it the magic shoebox. where they actually add fiber loops to normalize the transactions. So basically, it's a more fair exchange. It eliminates the ability. The IEX exchange eliminates the ability of these high frequency traders going through that exchange to front run that exchange. So that obviously made a lot of people very interested in IEX and drive trade flow to IEX. So I guess the point I'm making here is we talked originally about front running, and we're thinking about people and maybe nefarious or selfish activities that people are doing in manually processing trades. But the concepts behind front running becomes sort of different when we start talking about technology, where technology is giving a particular individual, particular broker or trading firm the ability to use technology to front run transactions or to get that level of an advanced benefit. So that's front running. Front running, again, just to go back, front running is when you're using inside information of a future event, whether it's a client trade or it's an announcement or it's some future knowledge that's not public. You're using that to benefit the broker. That's front running. If you have any questions, please give me a call. Please email me. You can find my email on the last page here. Paul_Judge@alumni.shu.edu. And as I've said on previous, I am an independent consultant, and I'm available for contracts, advice, or counsel if anyone's interested. Thank you, and have a nice day.